Hello, everyone, and welcome back to the Deep Dive. I hope you are having a fantastic week and are ready to tackle a company that is, well, it's quite literally the foundation of our modern digital life.
It really is. We are talking about the IP fortress that underpins, the entire global mobile world.
That's absolutely right. Today, we're doing a meticulous, deep financial and strategic analysis of Qualcomm, ticker QCOAOM. This is a name every tech investor recognizes, but I think the market's view of it is it's profoundly conflicted.
It is, because few people truly grasp the unique, almost bizarre structure of its competitive moat. It's not like other chip companies.
Exactly. And that's why we're not here to just skim the quarterly earnings report. We're here to tackle this central, really intriguing investment question that has plagued this stock for years. Qualcomm appears, on the surface to be this unassailable powerhouse. It's sitting on top of what looks like an undeniable intellectual property monopoly.
It certainly looks that way.
Yet the market perpetually, year after year, prices it as a purely cyclical stock, completely chained to the global boom and bust of the handset cycle.
So the structural shift we need to analyze today, the biggest question mark hanging over this company is this. Is Qualcomm actually finally successfully escaping its dependency on mobile phones?
Right.
Are we witnessing a fundamental structural transition right now? A shift from just being a cyclical component supplier to becoming a true secular technology platform that powers this connected, intelligent edge?
That pivot is everything. It's the core of the whole thesis and what will determine its valuation for the next decade.
That is a massive question, and I think before we dive into all the details, we should probably do a quick note for everyone watching.
Yeah, good idea. For those of you who want to act on these kinds of investment ideas, having a professional-grade platform is, it's absolutely key.
It is. You need tools that give you granular data access, low execution costs, and, just pure reliability. We use interactive brokers, and we've partnered with them to get you a stock bonus when you sign up.
So you get a bonus and you support the deep dives at the same time. That link is available right there in the description. And honestly, using professional-grade tools is essential if you want to be able to act on these insights in real time.
That's right. And of course, if you find value in this kind of in-depth structured discussion, the best way to let us know and to make sure you get the next one is to subscribe and like the video.
It truly helps the channel. And if you have any questions, any at all, regarding the company or this thesis, please drop us a comment below. We do read every single one.
Perfect. Now let's get into the analysis. Let's start with pillar number one, the core business structure and what makes this competitive fortress so formidable.
Let's do it.
Okay, so let's start with the dual nature of this beast, because Qualcomm's revenue generation is, it's famously complex, but it's also structurally really potent. It operates on two distinct yet deeply interconnected revenue streams. They call them QCT and QTL.
Can you lay that out for us? What exactly is the distinction, and why is that duality so fundamentally important to the investment case?
Absolutely. Think of it this way. QCT, which stands for Qualcomm CDMA Technologies, that is the hardware engine. This is where they sell the physical chips, the actual silicon.
The tangible stuff.
The tangible stuff, exactly. Specifically, the system on a chips, better known by their brand name, Snapdragon. This is the heavy-lifting, high-cost, R&D intensive side of the business.
And when you say system on a chip, we need to stress that integration point. It's not just a CPU.
No, not at all. It is a fully integrated command center. A Snapdragon chip integrates the CPU, the GPU for graphics, the critical wireless modem, and, increasingly important, specialized neural processing units, or AI engines. It's all on one piece of silicon.
Wow.
And they sell this hardware into mobile phones, obviously, but the massive critical strategic shift that we're tracking is its growing importance in these high-growth, non-handset markets.
Like what, specifically?
We're talking high-end automotive and the broader commercial and industrial Internet of Things, or IoT, the really big stuff.
Okay, so QCT is the cyclical, capital-intensive hardware business. But then you have QTL, Qualcomm Technology Licensing. This is the real fortress, isn't it? The cash cow, the toll booth.
That's it. This is where they collect those infamous, incredibly high-margin royalties.
And here's the critical distinction, the thing that makes Qualcomm so unique in the entire semiconductor world.
Yes. QTL's royalties apply to virtually every single device shipped globally that connects to a modern cellular network 3G, 4G, and crucially, 5G.
Regardless
of whether that device actually uses a Qualcomm chip.
That's just, it's still hard to wrap your head around. You could be using a competing chip from MediaTek or an in-house chip designed by Apple or Samsung, But if you want to connect to the global wireless standard, you have to pay Qualcomm.
You pay the toll.
And the basis for that payment, this is the part that still astounds people. It's not based on the cost of the chip, which might be, what, a few dollars?
No. It is calculated as a percentage of the final selling price of the entire device.
So a 5% royalty on a $1,000 flagship smartphone is $50. $50 in super high margin, high profit licensing revenue. And this all stems from their ownership of standard essential patents, or SEPs.
That's exactly why we call it the Tollbridge. And look, this model isn't just some leftover from the 3G or 4G era. The endurance of this whole dual structure is tied to fundamental, structural trends that aren't going away.
Okay, like what?
First, just global connectivity. The fundamental human and business need for wireless data transmission isn't going away, it's expanding. It's going into every domain you can possibly imagine, from logistics tracking to factory robotics.
And second, there's the intelligent edge. That term gets thrown around a lot. What does it actually mean in practice, and why is Snapdragon so uniquely positioned to own it?
So the intelligent edge refers to the migration of computing power and AI processing off of the remote cloud and back onto the physical device itself.
So out of the data center and into your hand, or your car.
Exactly. Think about autonomous driving or industrial automation. These applications demand ultra-low latency. You cannot wait for a decision to travel to a distant cloud data center and back.
Right, if a car's about to hit something, it can't afford that round trip.
The decision has to happen instantly, right there on the car or on the factory floor robot. Specific use cases are things like augmented reality glasses needing real-time object recognition, or drones navigating really complex environments.
Or inside a factory, optimizing some complex piece of machinery.
Precisely. All of these applications need high power, but also low energy consumption processing, and it has to be integrated with world-class connectivity. Snapdragon is optimized for exactly this trifecta: power efficiency, integrated AI processing, and dominant wireless IP.
So that's where the QCT pivot, which is financed by QPL, becomes so crucial.
It is the entire game. And the third foundational element fueling this model is, well, it's just human desire. We always demand better, faster, more integrated mobile devices. And that constant demand for the next best thing fuels the need for Qualcomm's next-generation IP and technology. It's what specifically funds their massive R&D efforts for 6G and next-gen AI architectures.
Let's unpack that moat now. If QCT is the engine, QTL is the fortress wall. But, an investment thesis can't just rely on a moat being strong. It has to be durable. And frankly, I want to challenge the idea that it's unassailable, especially with the constant regulatory pressure we see.
That's a very fair challenge, because the history of this moat is basically defined by warfare. But its durability is rooted in intangible assets. Those standard essential patents, the SEPs. These are patents that must be used to comply with the technical standard, like 5G. Since the entire global telecommunications ecosystem agreed to use the 5G standard, and Qualcomm contributed foundational patents to create that standard, they earned the right to charge a royalty.
But the way they enforce that royalty, the pricing power is just incredible.
It is. The moat in action through QTL is their ability to charge this annuity-like licensing stream based on the total device value. And this is where that fierce litigation history comes in. That history is what proves the moat's strength.
We're talking about years of legal battles, right, against absolute giants like Apple and even government bodies like the US FTC.
Precisely. The most famous example, the really long, protracted litigation with Apple, was finally settled in 2019. And that settlement confirmed the validity of Qualcomm's IP and its licensing structure, which led to a new long-term patent license agreement.
And they fought off the government, too.
They did. The successful navigation of all those antitrust challenges, including the very high-profile FTC case that ultimately failed on appeal, established a really clear legal precedent for the durability of the current licensing model.
So when you say it's unassailable, you don't mean no one challenges it. You mean it's been consistently upheld against the most determined and well-funded opponents in the world.
Exactly. That's the key distinction.
Okay, so the core moat is stable. I'll grant you that. But for the stock to be a secular winner, the moat needs to be widening. Where are the tangible signs that it's expanding?
The widening of the moat is entirely driven by the QCT diversification strategy. It's all about moving into markets with very long design cycles and high barriers to entry. And the prime example, the number that needs to stick with every single investor, is automotive.
Let's contextualize that. We keep mentioning this $45 billion design win pipeline in automotive. What does that number actually represent?
That $45 billion is not current revenue. That's a critical point. It is the estimated future revenue that is locked in over the next 5 to 7 years through contracts with major automakers.
So how does that compare to what they're doing now?
Well, to put that in perspective, the current annual revenue from the entire automotive segment is in the range of, say, a few $1 billion. This pipeline alone represents a potential revenue stream that is multiple times the current size of the whole segment. It's an enormous forward anchor for growth.
That's a profound point, because locking in $45 billion in future revenue establishes extremely high switching costs. If a major car manufacturer commits to using Snapdragon for their digital cockpit, for their advanced driver assistance systems ADS, and for their telematics,
They're locked in.
they're effectively locked in.
Right.
They can't just switch platforms halfway through a 7-year vehicle life cycle without immense cost and complexity. It would be a nightmare.
Exactly. So the QCT diversification is transforming QCT into a foundational platform provider for multiple secular growth trends, not just a cyclical chip seller for phones.
And this transition, it structurally strengthens the overall fortress, doesn't it? Because it reduces the company's dependence on that volatile handset market.
It's the whole point. The less QCT relies on handset cycles, the less the overall stock price acts like a cyclical semiconductor stock. And that is the entire goal of the current CEO's strategy.
This brings us to connecting Qualcomm's model to some of the established investment mental models we like to use. The structural genius of the company really is the symbiosis between that high-inflation annuity and the high-risk innovation.
It truly is a textbook example of Charlie Munger's concept of the Tollbridge. The QTL segment is the quintessential Tollbridge business.
It's an essential, unskippable fee on a massive, global, and inevitable activity. Wireless device sales. You simply must pay the toll to cross the bridge. There's no other way.
And that toll, crucially, allows them to skim a high-margin percentage of the entire industry's total revenue, which then funds the whole enterprise. It's a mechanism for capital generation that their competition just does not possess.
But then there's the challenge of the big bets required for the QCT hardware side.
Right. You can't survive in the semiconductor industry just by collecting patent checks. To keep the IP relevant for 6G and the next generation of on-device AI, the QCT segment needs massive, forward-looking R&D spending.
We were talking about R&D expenditures that often exceed $2.2 billion in a single quarter.
In a single quarter. That is the cost of staying on the cutting edge of technology.
Which creates this self-reinforcing virtuous loop.
Exactly. The stability and the high margins of the QTL toll bridge finance the necessary big bets in QCT. They are constantly funneling billions of dollars into ensuring they are the first to create the next standard, be it 5G, 6G, or the dedicated architecture needed for edge AI processing.
So without that reliable high-margin QTL cash flow, QCT could never sustain that level of R&D spending to maintain its competitive edge against titans like Apple or Nvidia.
They couldn't. It would be impossible.
And this is where something like the Nuvia acquisition comes into play, isn't it? That was a huge bet, and it was aimed precisely at maintaining that technological lead in QCT.
It was a critical forward-looking maneuver. They acquired Nuvia for $1.4 billion. These guys are experts in high-performance, low-power ARM architecture design.
And the key driver for this was Apple, right?
It was competitive parity with Apple. Apple's transition to their own custom silicon, the M-series chips, gave them a huge performance advantage in power-efficient computing. Nuvia's expertise allows Qualcomm to design their own custom, high-performance CPU cores that can be integrated into future Snapdragon SoCs.
So it makes them competitive against Apple's own silicon in both performance and power efficiency.
That's the goal. So you see the loop. QTL pays for the talent and the technology, like Nuvia, that QCT needs to ensure its chips remain cutting edge, which in turn ensures Qualcomm remains foundational for the next generation of technology, which then protects the QTL cash flow.
It's a perfect circle of profitability and innovation.
Let's look at the competitive landscape. Because no matter how strong the moat is, you have some serious players trying to chip away at it, and they're all coming from completely different directions.
Right. You've got MediaTek coming from the low to mid-range volume perspective. You have Apple vertically integrating from the very top. And then you have Nvidia, which is challenging the very nature of computing at the edge.
Starting with MediaTek. Their strategy is pretty straightforward. Achieve high volume through really aggressive pricing, and they're primarily focused on the lower to mid-range mobile SoCs.
They are the market share aggressor, They're consistently challenging Qualcomm in emerging markets.
They are, but Qualcomm maintains two durable advantages that MediaTek fundamentally lacks.
Okay, what are they?
First, just superior flagship performance. Snapdragon remains the undisputed performance leader at the high end, especially in demanding things like gaming and complex AI applications.
And second.
Second, and this is the structural one, MediaTek has to earn its profit solely from selling the chip. Qualcomm, as we've discussed, has the QTL Tollbridge funding QCT's massive R&D budget. This gives QCT a structural cost and technological advantage in maintaining its lead. MediaTek has to work harder and sacrifice margin just to try and keep up.
Okay, then we face what the market often perceives as the existential threat, Apple. Apple has made it very clear they want to design their own silicon end-to-end, and that includes, eventually, replacing Qualcomm's modem chip with their own in-house design.
Apple represents the risk of losing a huge customer in the QCT segment. But we have to analyze the scope of that risk. Apple is a closed ecosystem.
A walled garden.
A walled garden. Qualcomm's advantage is its platform agnosticism and its licensing breadth. Even if Apple succeeds in building its own modem, and we should note that process has been fraught with difficulty and delays, which just proves how complex Qualcomm's IP is.
Sure.
Qualcomm is still essential to the entire non-Apple wireless world. They receive payments from Samsung, from Xiaomi, from Oppo, from every major player in the Android universe, and they license their IP to Apple.
So even if Apple completely stops buying their chips, QTL still gets its royalty payments from every iPhone sold. The most profitable segment remains intact. That's a crucial mitigation factor.
Precisely. And that gives them far broader reach and much more diversified revenue streams than Apple could ever achieve through its walled garden approach.
Finally, let's talk about Nvidia, especially in automotive and AI. Nvidia is focused on these discrete, high-powered GPUs for data centers and AI training, and they are rapidly growing their presence in embedded systems and automotive compute platforms. This looks like a direct conflict with that $45 billion pipeline you mentioned.
It is a conflict, but it's a different theater of war. Nvidia is focused on maximum throughput and high power acceleration. This typically demands significant power and cooling. Think about training large language models or running complex high-definition visualization in a car.
So Nvidia's advantage is in the high power stuff.
Yes. Qualcomm's advantage is in the edge application. It's in wireless IP dominance and power efficiency.
So while Nvidia dominates the centralized training, the brain in the cloud, so to speak, Qualcomm is optimized for the local, real-time decision-making, the distributed nervous system where the power budget is absolutely critical.
Exactly. Their silicon is engineered for on-device, power-efficient AI at the intelligent edge. And critically, even NVIDIA systems need to connect to the network. And to do that reliably, they often need to leverage the wireless standards that are underpinned by Qualcomm's IP.
So Qualcomm owns the fundamental connection wire that makes all of this edge computing possible in the first place.
That's the bedrock.
Let's pivot now to Pillar 2, the qualitative view of management and the resulting financial resilience. Because a great business model, especially one that's under such intense competitive and regulatory scrutiny, it requires exceptional stewardship.
The current strategic leadership under the CEO, Cristiano Amon, is centered on a very clear long-term vision, diversification and elevation. His whole philosophy revolves around leveraging that foundational IP and technology into the connected intelligent edge to, frankly, change the market's entire perception of Qualcomm.
Okay, I have to introduce some friction here, because investors have heard the diversification story before. Why should we believe management is going to execute this time when previous cycles seem to just leave them just as dependent on mobile?
That is the essential challenge. What makes this time different is the quality and the scale of the targets. Automotive and industrial IoT. These are not just incremental, mobile-adjacent markets. They are massive, enterprise-level opportunities that require multi-year commitments from customers.
So the goal is a deliberate, strategic pivot to de-risk the business and expand their total addressable market, their TAM, by transforming Qualcomm into an enterprise supplier.
Which means less volatile, multi-year contracts.
Let's look at management alignment. How are they paid? Is their compensation aligned with shareholders?
When we analyze their incentive alignment, we see a textbook performance-driven structure. Amon's total compensation package is very heavily weighted towards stock and bonuses. Something like 94.8% is performance-aligned.
So that high percentage ensures his focus remains squarely on long-term shareholder value and executing this transition.
It should. However, we have to retain our objectivity here. We did note the low absolute insider ownership, which is roughly 0.015%.
It's very low.
It's tiny. And while the pay structure aligns performance, that low absolute ownership means it's less of an owner-operator mentality, which can sometimes lead to short-term thinking despite a long-term pay structure. It's a factor that warrants continuous monitoring, for sure.
Okay, let's move to the capital allocation track record. This is the rationality test.
For a company generating this much high-margin cash flow, management executes two priorities, I think, flawlessly. First, heavy R&D reinvestment, which we've discussed, the billions required to maintain the moat. Second, significant shareholder returns via aggressive share buybacks and consistently increasing the dividend.
The consistent dividend increases signal maturity and confidence, and the buybacks are tactical. They use that massive free cash flow to reduce the share count, which is a textbook shareholder-friendly decision for a cash-rich, mature tech company.
And the strategic acquisitions, like Nuvia, show they are deploying capital into high-growth, high ROIC markets like automotive and AI. It's very disciplined.
Now, for the financial fortress itself. While the underlying profitability is exceptional, a direct result of that QPL Tollbridge, we have to acknowledge the market noise.
We do. Due to legal settlements, one-time tax charges, and the high volatility of the semiconductor cycle, the GAAP earnings can look profoundly messy and, frankly, unreliable.
So we have to look beyond the reported net income and focus on the key quality ratios. Let's start with return on invested capital, or ROIC. This is the ultimate metric for measuring how effective management is at deploying shareholder capital.
Qualcomm's ROIC is consistently high. It's the hallmark of a wide moat business. Historically, it has often surpassed 20% over the past decade, even amid those periods of litigation chaos.
And where is it now?
Even currently, the TTM, the trailing 12 months data, suggests a highly respectable ROIC near 19.7%. This signifies an excellent quality business generating substantial returns well above its cost of capital.
But the real financial secret weapon here is the free cash flow conversion. This is the qualitative signal that the market often misses when it's just looking at those noisy GAAP PE ratios.
Yeah, exactly. Look at the disparity in the trailing 12 months data. We see free cash flow of $12.834 billion versus a reported net income of only $5.4 billion.
That is a massive difference. It means the business is generating significantly more deployable cash than its reported GAAP net income suggests.
So why does this happen? We need to explain this clearly for everyone.
Please do.
The disparity is typically driven by large non-cash items that hit the net income line but don't actually deplete the company's cash. The most significant items are substantial depreciation and amortization charges, which are related to their past capital expenditures and acquisitions.
And what else?
Furthermore, accounting rules sometimes mandate these large non-cash charges related to deferred tax liabilities or accrued legal settlement costs. These can dramatically reduce GAAP net income temporarily, but they don't impact the actual cash flowing into the company's bank accounts.
So the reported earnings are significantly depressed by these technical accounting items, but the actual cash generation machine is just running at full tilt.
Precisely. The free cash flow margin is robust. It's approaching 29%. And the TTM enterprise value to free cash flow multiple sits at around 14.45. This tells us we are dealing with a powerful, highly efficient engine that generates liquidity to fuel R&D and shareholder returns. And it often makes the company appear much cheaper on an EV to FCF basis than on a traditional PE basis.
Finally, we need assurance they can survive a downturn. How strong is the balance sheet?
The balance sheet is a fortress, and it's designed for flexibility. Their net debt to EBITDA ratio is prudent, sitting at approximately 1.1. Their total debt of about $15.64 billion is well covered by their annual EBITDA of $14 billion.
So that financial strength is critical. It allows them to maintain R&D spending through the cyclical troughs, execute opportunistic acquisitions like Nuvia, or lean heavily into share repurchases when the stock is irrationally cheap.
Exactly. They have the firepower to be patient and strategic.
Now we enter the core debate. Valuation. This is where the structural disconnect between the quality of the business, the high ROIC, the robust FCF, and the volatility of the stock price becomes painfully apparent.
Qualcomm is fundamentally trapped in what we call the cyclical premium valuation. The market grants it a premium of PE, often in the 20 to 30 times range, because of the stable, high-margin QTL annuity. That licensing business provides a durable revenue floor.
But the market struggles to look past the larger QCT hardware segment, which is just so exposed to the extreme boom and bust cycles of the handset market.
Right. The market, in essence, treats the entire company like a highly profitable yet deeply cyclical hardware manufacturer.
And this brings us back to Buffett's adage. The price you pay determines your return. You have to understand where you are in the cycle to even think about buying this stock.
Let's analyze the two scenarios for the listener. Scenario 1, the foolish price. You buy at 35 times PE, which is the high end of its historical range, usually during an inventory restock boom.
You're paying a premium for growth that may not show up for another 18 to 24 months because the semiconductor industry is just inherently lumpy.
And you end up with years of flat capital returns while you just wait for the next trough to launch the stock higher. It's dead money.
Okay, scenario 2, the opportunistic price.
This is buying at 15 times PE. It often hits this level during a cyclical trough or a major regulatory panic that temporarily depresses the stock. If you buy there, the mathematics of your investment change fundamentally.
How so?
You are essentially acquiring the stable, high-margin QTL licensing business at a negligible cost. And you are getting the accelerating automotive and IoT growth at a steep discount. That entry point is what leads to those outsized multi-year returns once the cycle inevitably turns.
Given that volatility, how do we define the margin of safety when we're dealing with this company?
The margin of safety relies on two safety factors that are just inherent to the business structure. Safety factor 1, the QTL floor.
The Tollbridge.
The Tollbridge. The high-margin, annuity-like licensing business acts as a durable revenue and cash flow floor. No matter how bad the QCT handset cycle gets, that high-margin cash keeps flowing in, insulating the business from a terminal loss.
And safety factor 2.
Market panic. The real margin of safety is found when the market overreacts to a temporary issue, say a quarterly revenue miss because of channel inventory drawdowns in Asia, or a temporary legal headline about royalty rates.
The market treats these temporary setbacks as if they're structural failures.
And that allows sophisticated investors to acquire the stock at a multiple that completely ignores the long-term structural growth that's being provided by automotive and IoT.
So let's identify the engine for future secular growth. It is unequivocally the accelerating diversification into automotive and IoT, all driven by the Snapdragon platform.
The strategic goal here is profound. Shifting the revenue mix to less cyclical, higher margin, long design cycle markets. This means multi-year, multi-billion-dollar commitments for in-car compute, for factory robotics, for complex medical devices.
Okay, now let's face the risks of permanent impairment, the extreme bear case that completely breaks the investment thesis.
The first one is fundamental IP obsolescence. What if the next wireless standard, 6G, arrives and a competitor manages to bypass Qualcomm's foundational IP in a way they just couldn't with 5G?
That would permanently impair the high-margin QTL business. It would turn the golden annuity into a legacy stream.
It would be a disaster. The second risk is the customer departure scenario, the dreaded two-front war of customer concentration. Apple successfully and permanently insources its modem chips, which is a massive QCT headwind.
And at the same time,
And simultaneously, a major Chinese OEM, maybe supported by government funding, develops a competitive proprietary SoC at scale.
that combination would be devastating. It would permanently have the QCT total addressable market and remove the key competitive lever they have against the Android ecosystem.
It would force Qualcomm to drop margins drastically just to compete for market share in a much smaller remaining pool.
We should probably also address regulatory risk. More specifically here. The antitrust litigation is a generic risk, but what are the specific regulatory challenges that are facing the QTL model globally right now?
The risk persists because regulators all over the world are constantly challenging the fairness of the royalty calculation, specifically basing it on the device price rather than the chip cost. And while the U.S. challenges have largely failed, courts in the EU and Asia, particularly China, continue to impose caps or negotiate lower royalty rates. This erodes the top-end profitability of QTL. If multiple jurisdictions successfully enforce a strict cap on that royalty rate, the annuity still flows, but at a significantly reduced margin, and that would permanently reduce its valuation.
Okay, on the flip side, what are the near-term and medium-term catalysts that could unlock value here?
Number one is accelerated diversification milestones. We need concrete, undeniable evidence that this pivot is working. We need clear, consistent demonstration that they are exceeding their targets for non-handset revenue automotive and IoT, specifically by their targeted year of 2029.
And success there would signal a definitive structural de-risking of the business, right?
Yeah.
It would shift the revenue mix to the point where mobile cyclicality becomes a footnote.
And that would lead to a permanent multiple re-rating. They'd move away from being valued as a cyclical semi-stock towards a high-growth, secular technology platform profile. That could potentially add 10 multiple points to the valuation.
What's the second potential catalyst?
It's more tactical, a major share repurchase program. Given their robust FCF generation and strong balance sheet, a massive opportunistic buyback executed during a cyclical downturn, when the stock is trading at those low 15 times EV to FCF multiples, would immediately reduce the share count by a significant percentage and create immediate value.
They'd be capitalizing directly on the market's irrationality.
Exactly.
Let's summarize this conflict between the market consensus and the contrarian view. This requires us to engage in some second-level thinking.
Okay, so first-level thinking is the market consensus. Qualcomm is a high-quality but cyclical semi-stock perpetually tied to the smartphone market.
The diversification story is nice, but the revenue contribution isn't yet big enough to fundamentally move the needle. Therefore, the stock is a hold or maybe a trade, but not a long-term investment.
Right. The contrarian view, our second-level thinking, is that the market is profoundly undervaluing the magnitude and the timeline of the structural shift that is already locked in.
That $45 billion automotive pipeline and the deliberate focus on the intelligent edge represent new, long-duration revenue streams that are far less cyclical.
And these new revenue streams will eventually make the cyclicality of the handset market a minority concern, likely within the next 5 to 10 years. And we have to remember, the QTL Moat isn't just a legacy asset. It is the incredibly stable bedrock that's financing this entire future transition. It provides the capital buffer they need to execute the pivot flawlessly.
So our conclusion, therefore, is that Qualcomm is actively transitioning from being merely a cyclical mobile component supplier to a secular, multi-market foundational technology platform company.
It is a slow, multi-year shift, but it's one that warrants a much higher non-cyclical valuation multiple once that revenue mix crosses the critical threshold.
Let's summarize the investment thesis with the traditional bull versus bear synthesis.
All right. The bull case rests on 4 pillars. 1, the unassailable moat. QTL provides a high-margin, annuity-like floor, legally tested and upheld time and time again.
2, high financial quality. It's a proven quality business with quality management, evidenced by that consistent high ROIC and superior free cash flow conversion.
3, secular diversification. The successful pivot to automotive and IoT, backed by that huge $45 billion pipeline, will definitively de-risk the company over the next decade. And 4, financial flexibility. The robust FCF supports all the necessary R&D reinvestment and significant opportunistic shareholder returns.
Okay, now the bear case. The reasons the stock might fail. It also has 4 pillars. 1, customer concentration. Continued high reliance on the volatile handset market and the persistent threat of Apple insourcing the modem.
2, gross margin pressure. Intense competition, specifically from MediaTek and in-house OEM chips that could commoditize the mid-range QCT chips.
3, regulatory risk. Persistent global antitrust and IP litigation risk aimed at permanently reducing that core QTL royalty rate.
And 4, execution risk. The diversification efforts, while they look promising on paper, may fail to scale quickly enough to truly offset the severe volatility and cyclicality of the mobile market, leaving them perpetually tethered to it.
Let's finish with the red team challenge. The most compelling argument for why this investment could fail long-term, turning into a multi-year value trap. We have to challenge the stability of the moat and the effectiveness of the diversification at the same time.
The ultimate failure mode is the two-front war. Severe moat erosion coupled with failed diversification efforts. Imagine a future where the QTL moat is successfully neutralized. Regulatory pressure manages to cap royalty rates globally, forcing them to base their fees on the chip cost, not the device price.
And technologically, a successful bypass occurs. An open-source architecture like RISC-V, combined with in-house modem development, gains widespread adoption by all the major OEMs, not just Apple.
That combination squeezes the high-margin QTL business down to a fraction of its current value, maybe a third of what it is today. It's no longer the gold-plated annuity, it's just a nice little cash stream.
And at the same time, the QCT diversification fails to generate high ROIC returns. What if automotive chips become a low-margin commodity due to fierce price-based competition from Nvidia, Intel, and others? Then what are you left with?
In that catastrophic scenario, Qualcomm is left with a large, cyclical, lower-margin chip business QCT that's propped up by a shrinking legacy licensing stream QTL. The stock permanently trades as a value trap multiple, unable to generate the multi-billion-dollar FCF needed to sustain the R&D required to compete at the technological frontier.
That is the long-term failure mode we have to monitor for.
Absolutely.
So our final takeaway is this. Qualcomm is fundamentally a bet on a successful structural transition. It's a bet on a secular shift away from mobile dependency, financed by an unshakable yet consistently challenged IP mode.
And the key, as always, is valuation and timing. We want you to focus on the long-term implications of that $45 billion design win pipeline. Think about this provocative question. What valuation multiple must the market ultimately assign to Qualcomm when non-handset revenue definitively exceeds 50% of the QCT segment revenue? And how far off is that ultimate outcome currently being priced into the stock?
That is the homework. Thank you for joining us for this deep dive. As always, we encourage you to do your own diligence, click those links, and continue learning.
We'll see you next time for another deep dive.